Alright, you have a trading strategy, you backtest it and then you optimized it. The result goes like 40%, 50%, even might be 100% returns over a year. You think you found a secret strategy which is a holy grail. But what happens when you go live with the actual money? You start losing the money. So why does this happen? This is happen because of the mistake called overfitting through optimization. Essentially, you are asking the computer to give you the best settings for the particular data or the historical data that you provided. It is not necessary that this strategy is finding the market inefficiencies so that you can profit from it. Today, we are going to fix that. I am going to use a strategy and a method called walk-forward optimization and backtesting. So we are going to take a simple trading strategy which you all aware, which is 920 straddle, but we are going to take a variation of it on a Nifty. Let's see how the walk-forward optimization improves the strategy along with improving the confidence on our strategy. To understand this problem, imagine you have an exam tomorrow. When you do direct simple optimization, this is like knowing the question paper upfront and then you start memorizing all the answers. But what if the question paper changes tomorrow? You are going to fail the exam. In trading, this means taking all your data, say from 2019 up to 2025. So when you do that, you are essentially asking computer what stop loss has given the highest return on this trading data, and it's going to throw out a number like 22%. But is the 22% real number that is going to give you the money? No, because it is giving the 22% because it has worked on the particular data set. If the market behaves like the data you have given, so it's going to make you profit, but that happens rarely. The market data changes constantly. So when you use this 22%, you are going to lose the money. It only worked on the data because you have given the data and it has optimized on the data. This is called overfitting, and some people call this curve fitting in a trading terminology. Now let's look at the solution, walk-forward optimization. Instead of looking at the whole timeline at once, we break it into pieces. We treat the market like a rolling window. For example, we have the data from 2019. So we take 1 year of data, which is in 2019, from January up to December. We find the best settings in this period and then we take those settings and then test it on January to March in the next year, means following 3 months. Then we are going to forget about the old data. Then we are going to move the period by 3 months. Then we are going to re-optimize during this period, which is 2019 April to 2020 March. So when you do that, you are getting a new settings, and then that we are testing on 2020 April to 2020 July. So this way, you are keep moving this period and then you are finding the best settings and then you are testing it on the following 3 months. So that way, if I look at it, for 2020, we have 4 green periods. So for the whole year, we have the out of sample period. So that means this period has never seen the data when we are optimizing with the data from the previous 12 months. So those optimized settings, if they are working well in these 4 periods, that means we have a good confidence because we are re-optimizing multiple times and the strategy is still working. So this strategy is robust and not overfitting to the parameters that we have. So we repeat the process all the way up to 2025. So if I'm scrolling to the right, let's say for 2025, how does it look like? So if I want to trade between October to December in 2025, then I will take previous 12 months data, which is October 2024 till September 2025. Then I am going to optimize the parameters during this period. And then I am going to trade using those optimized parameters from October to December 2025. And after that period, I will move again 3 months. Then I am going to retest in this period. And then I am going to trade using those best setting in 2026. That way, for every 3 months, I am optimizing the strategy. So over the multiple years, we have tested the strategy on the out of sample periods. That's why we will have higher confidence. And there is a very low chance of overfitting if the performance is good after the walk-forward optimization. Let's see this in action. We are going to use 920 straddle variation on Nifty. So for that, I am going to use Algo Test. So Algo Test is a website where you can do backtesting, forward testing, and then algo trading. So if you use the link in the description, you are going to get extra credits when you sign up in the Algo Test. So I am going to the dashboard. I have an already account. So under backtest, I am going into the strategies. So here I am going to take index as Nifty and entry time as 9:20 AM instead of 9:30, and then exit time as 2:59, which is like we are exiting at 3 PM. Instead of ATM, we are going to select premium greater than or equal to 30, and then I will add this leg. So you can see sell, call, expiry is weekly, and then premium greater than or equal to 30. For stop loss, I am going to pick 50% stop loss. And for trailing, I will use 10% and 5%. So that means whenever price moves by 10%, stop loss is going to be moved by 5%. I will duplicate this leg. Instead of call, now we have put. So we are basically selling call option and put option where the premiums are greater than 30 with a stop loss of 50% and trailing of 10% followed by 5%. So this is a simple strategy. We are going to enter at 9:20 and then exit at 3 p.m. And I will use all the data here to show you the baseline performance of this strategy from 2019 till 2025. Then once I click start backtest, so within few seconds we are going to see the results. So now we are seeing these results. Let's add taxes and charges because these are anyway you are going to pay for the government and the brokers. And then I am not going to add any brokerage. The reason is that I am trading Kotak Neo. I will give the link in the description. You can open account free. And then brokerage is 0 when you trade through API in a way through this algo test. We need to add the slippages. You are not going to get the same price when you do real trading compared to what you are seeing in this backtest. So let's add 0.5%, which is good based on my experience. And for a DTE filter, I am going to select only 0 and 1. That means I am going to trade this strategy only on the expiry day and the day before it. The reason is that since we are doing option selling, theta decay is highest on the expiry day and the day before that day. And then if you are pledging your holdings, then you are going to generate additional money on your mutual funds or stocks that you have invested and then trade. Because this is intraday trading strategy, you can use 100% of your pledged collateral. So I have downloaded this and then I used my own code to get the metrics so that I can do comparison between this and then Walk-Forward optimization. So here we are optimizing between 19 and 20. This is the whole 1 year, 12 months, and then we are going to test it on the 3 months. And then we move this window for 3 months, and then you can see all the way up to 2024. We have 16 runs where we have optimized and then test it on the out of sample data. And then the curve you see here, it's only for this red portions. That means it is completely out of the sample performance. So we have higher confidence on this strategy now. As I discussed, the two main benefits are you are seeing the full out of sample performance rather than optimized backtest result. So you have higher confidence. And second reason is that since you are re-optimizing for every 3 months, then the optimization is considering the recent volatility of the market. So updated parameters are always with updated market data. And this is basically my website. If you want to go into the more details, I will give you the link in the description. And then for Walk-Forward optimization, we are going to use 3 parameters, which is entry time. Instead of 9:20, we are going to use 9:45 and 10:30. Premium we will keep as 30, but SL percentages instead of 50%, we are going to check 30 to 70% separated by 10% gap between them. So in sample is 12 months and out of sample is 3 months. So for every 12 months, we move the period by 3 months and then test it on the 3 months. So when we look at the base strategy, the strategy that I explained above, you can see after 2023, it has become a flat and then drawdown is also higher. And then it has made pretty good return except in 2023. And then return to drawdown ratio is 4.5. So which is a pretty good strategy even for the base strategy without any optimization. When you optimize it, you will basically overfit it and then you make it worse because you will just fit it on this data and it may not perform well going forward. So in Walk-Forward method, what we are going to do is, like I mentioned, we are going to do through multiple runs. First run is 2019 January to 2019 December. This is our in sample, and then out of sample is going to be 2020 January to 2020 March, which is nothing but 12 and 3 months. And optimized numbers for this period is 920 as the entry time and then 30 as the premium and 50% as the stop loss. And it had 184 trades in sample with a return of 20%. When we look at out of sample, it has 54 trades for 3 months and then with an average annualized return of 12%. So this return is using the parameters that we optimized for the in sample period. So we repeat this process for every 3 months. We shift the period by 3 months for the in sample, re-optimize and then retest on the next 3 months. So this entire out of sample performance is what we aggregate and then get the results. So here the return to drawdown ratio is 5.6 and the stability is 86%. That means whatever return we are getting in in-sample optimization, we are getting 86% of that return in out of sample, which is pretty good. And if you look at the comparison, the base strategy, the returns are 16%, and in optimized walk-forward optimization, it is 17%. And return to drawdown ratio increased from 4.5 to 5.7. So even though this is not a big jump, but this is giving us confidence, whatever parameters we are using, whatever optimization we are doing, we are definitely not overfitting. The reason is that it has worked over multiple out of sample periods. And even if you look at from 2024 to 2025, the data is going to show us like the return to drawdown ratio is still good, 4.3, and then return stability is still good, 86%. In original base strategy, the 2023 was like 1%, this is like 11%. This strategy I personally trade in my own account. And then when we do Monte Carlo optimization, the drawdown is going to be 6.4%. This is at 95% worst case drawdown. So if our drawdown goes below 6%, then we stop trading this strategy. Ideally from backtest, we are seeing drawdown is only 3.5%, but worst case drawdown is 6%. So the walk-forward optimization is certainly better. Why is this better? It's not just because of the return increased or return by drawdown ratio increased. It is because our confidence has increased. The system automatically decides what stop loss, what entry time for every 12 months and then testing on next 3 months. And then the performance, if it is good on the 3 months, then we have a very good robust strategy. Markets change all the time. A 30% stop loss might work better in 2017 but may not work well in 2020 COVID crash time. Volatility is certainly different. So what do you do in this case? If you fix a stop loss based on 5 years data and then take it live, then you are getting average performance because the stop loss is neither good for 2017, neither good for 2020. But with walk-forward optimization, our strategy is adapting based on the recent 12 months. That is the real benefit of walk-forward optimization. You are testing for the robustness and also you are adapting your strategy for the recent market condition changes. So when you are building a system, don't look at returns alone. You need to look at return by drawdown ratio. But if you keep optimizing to maximize this value, then you are going to overfit it. So instead of doing that, you need to figure out what parameters you want to optimize, find out the ranges, and then conduct a walk-forward optimization. So you basically train it on 12 months and then test it on following 3 months, and then you walk forward by every 3 months. If your returns are good on all of these out of sample periods, then you have a robust strategy. I have given link to the entire strategy and detailed explanation in my blog post. I am giving the link in the below. Trade safe, don't trust your backtest blindly, and then conduct walk-forward optimization to ensure that your strategy is robust.